It's one of the most important cogs in the global financial machine, an instrument that's used to build $350 trillion worth of financial products across the world. It can judge the condition of the financial system, give an indication of a bank's strength, or even forecast the future rates of central banks. But the legitimacy of the London Interbank Offered Rate, the benchmark interest rate known as Libor, is being challenged. For the past 18 months, Libor has been the subject of investigations involving regulators and governments in the US, Europe and Japan, as well as a small army of major financial institutions, in what could amount to the most significant inquiry of the banking sector since the financial crisis began in 2007.
So what is Libor? Well, put simply, it's the rate at which banks can lend and borrow from each other. That means it has a direct impact on anything else that a bank might issue, such as your mortgage, repayments on your car, or how much it costs a company to take out a loan.
Under investigation is the allegation that Libor and other key benchmark lending rates may have been manipulated by certain bank employees during the financial crisis. This would have benefited the banks because a favourable rate could hide the weakness of any institutions that were struggling to raise funds in the money markets at that time. However, what's come to light during the course of the inquiry is that the alleged manipulation may be more widespread than first thought, and for a different reason. Could traders have been regularly affecting Libor and other similar rates to increase the profitability of their desks?
Libor is generated daily in 10 currencies, and it's a calculation that's overseen by this organisation, the British Bankers Association. It's a process that's been taking place for almost 30 years. At 11 o'clock each morning, a panel of about 20 banks here in London deliver a figure for the rate at which they say they could borrow from other banks that day. Within 15 minutes, all of those figures arrive with Thomson Reuters at an undisclosed location here in the UK. They're the official calculating agent charged by the BBA to determine Libor.
Tests are run on the numbers before the highest and lowest figures are removed. Thomson Reuters then run the remaining rates through a computer which takes a mean average and generates the Libor for that day. The allegation that individuals within the system could fix the rate to benefit positions they held is one that the BBA resolutely denies.
In addition to all of the pre-calculation and post-calculation scrutiny carried out by Thomson Reuters, all of the information that is submitted by all banks is passed to the independent technical committee, and they review this along with a raft of statistical analysis that we have done for them, and any information that is put in that looks anomalous or unusual, that bank is asked to explain why they put that rate in to the committee.
But as the FT's investment banking correspondent Megan Murphy explains, bankers have told her it is possible. And if it's proved that rates were significantly affected for a prolonged period of time, the scale of the damage to the sector could be immense.
Worst case scenario, this could morph into a sort of cottage industry of class actions against the banks, very similar to what we saw that came out of the CDO crisis, where we had several different big actions against Goldman Sachs, against JP Morgan Chase, and you saw the size of the settlements in that were hundreds of millions of dollars. I definitely think with Libor, as it develops and as it just seems the investigation is so sprawling, we're dealing with penalties that are going to be significant, whether that's on paying out damages in a class action lawsuit or whether that's straight enforcement actions from regulatory agencies across the world.
With so much at stake, is it time to rethink how Libor is calculated?
I think that in this changing world, it might well be that we come to a new way of doing these things. And again, we will have to consult with all of our stakeholders, and we will see further evolution of the benchmark.
Whatever the conclusions of the various investigations, it's more than likely that Libor and the way it's calculated will come under review. Adjusting a mechanism that's so integral to the financial machine will prove a complex operation, but no less so perhaps than restoring faith in the system as a whole. Morton-Clark, Financial Times, London.